Hello everyone, I'm John with JP Strategic Investments, and today I'm going to go over how much of Tesla's future growth is already priced into the stock. Now I know it's basically impossible to predict where Tesla's business will be 10 years from now, so I'm going to simplify this analysis a lot. Basically what I'm going to do is determine how much Tesla would have to be making in net income to justify their current stock price based on a PE ratio of 200. Then I'm going to go over how many cars they would have to be selling and where their energy storage business would have to be in order to make that much money in net income. And then from there I'm going to let you draw your own conclusions as far as how much growth you think Tesla has left and how long you think it will take them to get there. Also, if you enjoy videos like this, don't forget to like and subscribe for more content like this. And with that said, let's dive right into the video. So Tesla currently has a market cap of right around $730 billion, giving them a trailing PE ratio of just over 1500. Now, if you're not familiar with how PE ratios work, I recommend doing a quick Google search before continuing with this video just to make sure you can follow along. Now, as companies grow and get closer to maturing, these PE ratios tend to gradually come down over time. Usually a high PE ratio tends to imply larger potential for future growth, whereas a lower PE ratio tends to mean a company has matured or is close to maturing. For example, the average PE ratio in the S&P 500 is usually in the mid to low 20s. Companies that are still large but have room for growth usually have PE ratios between 30 and 100. I chose to evaluate Tesla at a PE ratio of 200 because I think sometime in the next 5 to 10 years it will reach a point where it still has a lot of future growth ahead, but it's getting closer to maturing. So to figure out how much money that Tesla would need to make to justify its current stock price at a PE ratio of 200, all we have to do is take Tesla's current market cap and divide it by 200. So $730 billion divided by 200 equals $3.65 billion. So that means that if Tesla's PE ratio were to drop to 200, they would have to be making $3.65 billion in net income per year to justify its current stock price. Or in other words, Tesla would have to be making just over $900 million per quarter in net income. Well, if we take a look at Q3 of 2020, Tesla delivered almost 139,600 vehicles, and that equated to roughly $7.6 billion in automotive revenue. Tesla also made $579 million in revenue from their energy storage business, along with $581 million in revenue from their service segment in the same quarter. All of this resulted in a GAAP net income of $331 million. So looking at this, it would seem that Tesla roughly has to sell 3 times as many vehicles per quarter than they currently do, and also triple their energy storage and service businesses. This would put them at enough net income to justify their current stock price with a PE ratio of 200. At first glance, this actually looks pretty good for Tesla. With their new factories coming online in Texas and Berlin, they could easily achieve this in less than 2 years. That would imply that there is less than 2 years of Tesla's growth priced into the stock. But it actually gets better than that. If we take a closer look at Tesla's net income, we can see that their non-GAAP net income was actually $874 million. And the only major reason for the difference between their GAAP and non-GAAP net income is Elon Musk's stock-based compensation for meeting certain milestones with the company. Tesla has already said that this compensation has peaked and will phase out soon. That means that Tesla's actual net income is much higher. This means that with Tesla delivering over 180,000 vehicles in Q4, their non-GAAP net income is probably already above 900 million, meaning that basically zero growth is priced into Tesla's stock. Or in other words, Tesla is currently trading at a forward PE ratio of less than 100, which is very cheap for a company with as much growth as Tesla has ahead of them. Now, obviously this analysis is very oversimplified and it assumes that Tesla is able to execute on all of their future plans and continue to grow as they already have. There will still be a lot of uncertainty over the coming months with COVID cases still rising and some of Biden's policies that could have very negative effects on Tesla's business in the long term, so take this analysis with a grain of salt. If you're confused at all as to why Biden's energy policies will be bad for Tesla, I highly recommend watching my video going over his policies in relation to Tesla. While it may seem counterintuitive, most policies that accelerate the adoption of electric vehicles will actually help Tesla's competitors far more than they help Tesla. And now that it seems that the Republicans will lose control of the Senate, many of these policies will likely be implemented. That being said though, I hope you found this analysis helpful, and if you did, please consider liking and subscribing. And also, don't forget to leave me a comment below letting me know what you think of this analysis and where you think Tesla stock will be in 5 years. Other than that, have a great day.